Liz Ann, what's your level of caution right now in the overall market?
Well, the official tactical position that we've had actually for a couple of years now is neutral. Within that, in the U.S. equity market, we've been overweight large caps, underweight small caps, so we're sticking with that. We've been emphasizing a more defensive tilt from a sector standpoint, but don't just go hog wild into the utilities and REITs. You have to be mindful of adding to them on pullback days. So overall, we still think we're in kind of this range-bound environment, and that the best position for investors to have is sort of stay close to their long-term strategic allocations and use some of these swings to rebalance back toward those targets.
What, Liz Ann, did the manufacturing GDP tell you earlier this week? And is that more important of an indicator than some of the stronger sentiment we've had out of the consumer?
Well, it told us what I think many of us already suspected, which is that we're in some form of manufacturing recession. I think that's very clear to be the case globally, and it was confirmed not only by the ISM Manufacturing Index, but prior to that, the market index. And that is not necessarily the death knell for the overall economy, but there's a reason why, even though manufacturing is only about 12% of the economy, it's still the largest contributor of a sector to the economy. And there's also a reason why manufacturing indicators dominate the leading indicators, because they do tend to lead broader turns in the economy. So far, there's a pretty defined line between the manufacturing side and the consumer side, but I'd keep a particularly close eye on the employment data. We're already seeing unemployment claims tick up in the more manufacturing-oriented states. If we start to see that spill over more broadly, then I think you start to chip away at what has been that firm dividing line between the two segments of the economy.
I've been going through a lot of research on the PMI data, the manufacturing. So basically, I mean, High Frequency Economics put out, Jim O'Sullivan, a good note last night saying that below 50, contractionary, it's happened before, and it hasn't necessarily indicated recession. In fact, when we do get to recession or approaching recession, we get to the low 40s or even below that. So I think as far as what the Fed should do and what investors should do with it, Josh, how much of a worry, how much of an indication?
Well, it's not cumulative data. It's an oscillator. So let's keep in mind, like, it could be below 50 1 month and then 55 the next month, and it doesn't trend. It's not the same as watching things like unemployment claims or auto sales. It's a very different animal. So with any data series that oscillates, like, okay, you should be aware of what it just reported, but then remember that's for last month. Sometimes it's even 6 weeks out of date, and things change really quickly. And high-frequency economics, the high-frequency part is the part you should remember. They're always taking that reading. I think bigger picture, and I've said this before, if you just focus on the consumer and the things that are important to the consumer, like jolts, quit rates, do people feel confident enough they can find a new job, look at wage growth, look at retail sales. That is the stuff that has made you money to follow over the last 10 years. If you've been focused too much on the manufacturing portion of the economy, and I'm not saying it's not important, I'm saying it's given you a lot of reasons to worry, a lot of reasons to come out of the market.
Some people say they said that about housing in 2007. It's a small part of the economy. It's not a leader of the economy.
No, I mean, housing is really big. Housing is really big part of the economy. For the typical consumer, it's way more important than the stock market. That's where all of the consumer's wealth is. You talk about the middle class and up, housing is perhaps the biggest. I don't know anyone that said that, but I understand your point.
What people say is there's never been a nationwide decline of house prices.
And they said it about subprime.
And that it doesn't lead the overall
small
economy into the recession.
Look, I think one of the issues is, and you had Fed officials today coming out and talking about how the consumer is kind of a coincident or lagging indicator of what's going on. Not to say it's wrong, but that it doesn't necessarily tell you how things trend from here. And I think that things like the ISM are more important to the corporate sector than they are to the real economy. And so it really kind of creates the rate of change in business-to-business spending and capital goods spending, which is overrepresented in the S&P 500 relative to how big it is in the overall U.S. economy.
The truth is, if I'd love to hear Liz's take on this. If you offer me one of the two, it's very easy for me to decide which one I want. You tell me, I'll tell you how much in buybacks were done a year from today, or I'll tell you what the manufacturing readings are. I would much rather know what the buybacks is. for me, that's how I would establish a baseline reasonably of what the supply-demand picture for S&P 500 looks like and what levels we might be at. I couldn't do that with manufacturing data.
You were buying them heavy in 2007, Josh, if that was your indicator.
Well, no, future, not past.
Oh,
future.
Right.
Future.